Hello, I'm Graeme Bibby, Chief Investment Officer, with an investment update on the 20th of June. Markets have gone through quite a lot of turbulence lately, as you would have noticed, with equity markets down into a correction material for the year, over 20% for the S&P, over 30% for the NASDAQ, and our market is well over 10% down for the year. In this environment, we've had a lot of changes that have caused that. The main one is inflation. With inflation in the US now 8.6%, surging again on the last reading to over 5% in Australia. This has caused central banks to bring out their inflation-fighting weapons, which is basically hiking interest rates. So we've seen a combination of the Federal Reserve hike rates at their last meeting in June by 75 basis points, which was a surprise, up from 50 basis points last time, and they're looking at more and more rate hikes into the future. The RBA also had a higher rate hike than their first one, so they did 0.5%, and that was up from their first hike of 0.25%. So at the moment we're seeing quite a lot of action on the central bank front to fight inflation. Unfortunately, these tools aren't going to solve the supply problems in the world. So central banks unfortunately can't print chips or baby formula or other goods and services that we need. However, these things will be solved over the long term, like the next 5 years or so. What we are going to see is more demand destruction from central banks with hikes like this, and that will mean that demand from consumers and businesses will slow, and in fact are slowing already. In the US, we're seeing retail sales down by 0.3% in the last month, and that's likely to be a continuing trend. We're seeing with companies earnings problems as well, so from top-line sales that are likely to continue to decrease, to cost inputs into those businesses rising from goods prices, services prices, and labour. So those impacts, we're seeing more pressure on company earnings going forward, and markets are starting to price that in. We think there's a lot more to go and potential for an earnings recession. While a full recession might not be priced yet, we think that that is the likely next move. And hence we've moved more underweight in the last week or so, and looking to be more defensive in our asset allocation across sectors, stocks, different investment styles, and size as well, so the size of companies. We think small companies are going to be worse affected in this environment. On the fixed income side, we've seen government bond rates rise quite dramatically, and that's also been in an environment where, in anticipation of a slowdown, credit spreads are rising. So the overall rate that you're getting on your fixed income investments is rising markedly. On a broad Australian fixed income index, for example, from 12 months ago, you were getting a yield all up of 1%, now it's closer to 5%. In this environment, a lot of that repricing has happened already, and we're much more comfortable to move from shorter duration investments, floating rate for example, into broad market where we can capture more of that interest rate return and interest rate spread. So that's part of our asset allocation there, and we're also raising cash as well, and we have raised cash over the last couple of weeks. We see opportunities as those markets continue to get repriced downwards, and that there'll be opportunities on the other side. So we still like many companies, and what we're looking to do is buy some of those companies back at cheaper prices. So there's going to be a lot of good bargains to be had, maybe not immediately, but over the next 3 months, perhaps 6 months, we'll see that. Asset allocation has been underweight equities from about the beginning of the year, where we went further underweight when the Ukraine war happened, and then we've moved more underweight recently. So we're near the bottom of our asset allocation range for equities. We're increasing some of the exposure to cash, increasing broad market fixed income, and we're looking at alternatives as a way to get broader exposure that's not directly correlated to public markets either. In this environment, it's important to have a risk management approach and to stay invested while being less invested into the riskier areas of the market. We see that there'll be opportunities to rotate back onto the other side, and we've got opportunities that we're pursuing and have been monitoring where we'll rotate back into. That's it for the update for this month, and look forward to talking to you all in person. Thank you.